The rules didn't suddenly change, but how strictly. And right now, that single difference is costing retirees money they didn't even know they owed. No warning, no phone call, just a letter, a repayment demand for benefits the SSA says you weren't entitled to, sometimes from 2 or 3 years ago. And by the time that letter arrives, the money is long gone. This is happening more often than most people realize. Not because the system watching for violations got smarter, automated, faster, and far less forgiving of the gaps that used to go unnoticed. Collecting any form of social security, retirement, disability, survivor, or supplemental, this video is directly relevant you've done anything wrong, but because the space between what you think your obligations are and what the SSAS systems now expect, that gap, overpayment determinations are being generated at a pace that is catching ordinary retirees. Stay with this entire breakdown, because by the end, you'll know exactly what changed, who it's hitting hardest, why the delay makes it worse, and what you need to do right now to protect yourself. And if you rely on clear, grounded information about policy shifts and that doesn't sensationalize and doesn't waste your time, make sure you're subscribed to Macro Signal before this video ends. We track these developments so you always have the information you need before it affects you. Let's get into it. For most of Social Security's history, the agency's ability to verify what beneficiaries reported was meaningful but limited. They could audit, they could flag inconsistencies manually, but cross-referencing tens of millions of beneficiary records against IRS income databases, federal agency records, and financial institutions in a systematic, automated way, that wasn't something the infrastructure could do at scale. Not quite has changed. Over the past several years, the Social Security Administration has significantly expanded its data matching capabilities. The IRS now shares income data, state workforce agencies share wage records, financial institutions report interest, dividend, and certain asset information. Medicare enrollment data feeds into eligibility calculations. These information streams are being cross-referenced against beneficiary records more systematically and more frequently than at any prior point in the program's history. The practical result is direct. If what you reported to Social Security doesn't align with what other federal and state agencies have on file about your income, the mismatch is increasingly likely to be caught, not by a human reviewer pulling your file, but by an automated comparison running across millions of records simultaneously. When the system flags a discrepancy, it can trigger an overpayment determination, a benefit recalculation, or a formal eligibility review, and it can do so for tax years that closed 1, 2, or even 3 years ago. That delay is one of the most important features of this system to understand because it's the part that blindsides people most completely. You're not flagged in real time. You move forward. You spend the money. You plan around the benefit level you've been receiving. And then, well after the fact, a letter arrives telling you the SSA has determined you received funds you weren't entitled to, and that you owe them back. This isn't theoretical. It's a pattern documented in SSA Inspector General reports, in congressional oversight hearings, and in the first-hand accounts of retirees who had no idea they were out of compliance until they were already being asked to repay thousands of dollars. Now, let's talk about who this hits hardest, and why so many people genuinely don't see it coming. The core misunderstanding most people carry is this. They believe that filing their federal tax return handles their compliance obligations with Social Security. It doesn't. The SSA and the IRS are separate systems with separate reporting structures. Your tax return tells the IRS what you earned. It does not automatically update the SSA about whether your earnings, resources, or life circumstances have triggered a reporting obligation under the specific program you're enrolled in. Those are two entirely different things, and conflating them is the single most common mistake driving the overpayment problem significantly depending on which Social Security program you're in. And this is where the confusion compounds. For standard retirement benefits, income doesn't reduce your monthly payment once you've reached full retirement age. But if you're collecting retirement benefits before full retirement age, there is an earnings limit. In 2024, That threshold was approximately $22,000 per year for those under full retirement age. If your earnings exceed that limit, the SSA withholds $1 for every $2 earned above it. That withheld amount is eventually credited back through a future benefit adjustment, but the timing and mechanics are not intuitive. Many people don't fully understand how it works until they're already on the wrong side of it. Critically, self-employment income counts toward this limit exactly the same way wages do. Consulting work, freelance contracts, project-based arrangements with former employers. All of it counts. People who leave their primary career, pick up part-time work, report every dollar to the IRS, and pay all their taxes. They can still end up with an SSA overpayment determination because they didn't realize those earnings carry the separate reporting obligation. The IRS and the SSA share data. They do not share responsibility for keeping your benefit records accurate. That responsibility stays with you. For supplemental security income, the reporting rules are even more detailed and the timelines are tighter. SSI is a needs-based program, which means income and resources are always directly relevant to eligibility and payment amount. The SSA expects SSI recipients to report changes within 10 days of the end of the month in which the change occurred. That is a narrow window. Earned income, unearned income, in-kind contributions, changes in household composition, changes in living arrangements, all carry reporting obligations. Missing them, even without any intent to conceal, can result in overpayment determinations and benefit adjustments that arrive months or years later. For Social Security disability insurance, the central concern is what the SSA defines as substantial gainful activity. Working while receiving SSDI is permitted under carefully defined conditions. There are trial work period provisions and other transitional mechanisms, but earning above the SGA threshold, which was approximately $1,400 per month in 2024, can affect your eligibility. The transitional provisions are genuinely complex, and many recipients make honest errors navigating them. Those errors get picked up by data matching months or years later, and by then, the overpayment amount has already accumulated. Let's make this concrete because abstract policy descriptions only get you so far. Consider a man named Robert. He's 63 years old. He took early retirement at 62 after a long career in project management. He understood that claiming early meant a permanently reduced monthly benefit, and he accepted that trade-off. What he didn't fully account for was the earnings limit. In the year after he retired, a former employer reached out and asked him to consult on a systems implementation project. It was project-based, not a formal employment arrangement. No W-2. He worked roughly 15 hours a week for about 8 months and earned approximately $29,000. He reported every dollar of it on his federal tax return as self-employment income. He paid self-employment tax on it. In his mind, his obligations were fully covered. They weren't. The earnings limit for someone in Robert's position applied directly to that income. His earnings exceeded the annual threshold by approximately $7,000. Under the SSA's formula, that meant roughly $3,500 in benefits should have been withheld during that calendar year. Because Robert didn't report the self-employment income to Social Security separately, no withholding occurred. He received the full benefit amount every month. Without months later, Robert received a formal overpayment notice. The SSA's data matching system had compared his benefit records against income data the IRS transmitted for that tax year. The letter cited the specific year, calculated the overpayment at $3,500. It outlined his options: repayment in full, a structured monthly arrangement, or a formal request for waiver or appeal. He had 60 days to respond. If he didn't, the agency would begin recovering the overpayment automatically by withholding a portion of his ongoing monthly benefits. Robert wasn't careless. He wasn't trying to take anything he hadn't earned. He simply didn't know that self-employment income carried a separate Social Security reporting requirement, or that the IRS and the SSA, despite sharing data, did not share responsibility for keeping his benefit records accurate. His situation is not rare. It is the scenario playing out with increasing frequency as the SSA's automated systems surface discrepancies from prior years across the beneficiary population. This is exactly why staying ahead of changes like this matters. If you're not already subscribed to Macro Signal, now is the right time. We break down exactly this kind of policy and administrative development, clearly, without the noise. So you're nevertheless to know when the rules tighten around something that directly affects your income. Now here's the part that almost no one talks about, and it has nothing to do with income reporting. This is where a lot of otherwise careful retirees get blindsided. Most beneficiaries, when they think about their SSA obligations, think about earnings. What they rarely consider is that a wide range of ordinary life events carry their own independent reporting requirements. And the SSA's data systems are increasingly receiving information about those events from outside sources, which means that even if you never report the change, the agency may find out anyway. And when the records and your life don't match, that discrepancy becomes a problem. Here's what that looks like in practice. If you receive SSI and you get married, that's a reportable event. Marriage changes household income calculations and can directly affect your benefit amount, sometimes significantly. If someone moves into your home and contributes to shared living expenses, even informally, that's potentially reportable as in-kind support. If you inherit money, receive a legal settlement, or are named the beneficiary of a life insurance policy, those are reportable resource changes for SSI recipients. If you leave the United States for more than 30 consecutive days, your SSI eligibility is suspended for that period. And not reporting your travel can generate an overpayment for every month the system shows you collecting a benefit you were no longer eligible to receive. For SSDI recipients, there's a rule most people have never heard of until it affects them directly. If you begin receiving workers' compensation payments at the same time as your SSDI, the SSA applies an offset calculation. The combined total of both payments cannot exceed a defined percentage of your prior earnings. If it does, your SSDI is reduced accordingly. Many recipients don't know this rule exists. They sustain a workplace injury, start receiving workers' comp, continue collecting SSDI without reporting the new income, and eventually receive an overpayment notice calculated across every month the offset should have applied. The category of unreported change that generates the longest overpayment periods and the largest dollar amounts. Not income from part-time work, life events, changes in circumstances that feel personal and unrelated to a government benefit, but that the program's rules treat as directly material to eligibility. The reason this matters more now than it did 5 years ago is the same reason everything else we've discussed matters more now. The data is flowing. State agencies, federal departments, and in some cases financial institutions are transmitting information to the SSAS systems that previously arrived slowly or not at all. The agency doesn't need you to report your marriage if it shows up in state vital records data. It doesn't need you to report a legal settlement if it surfaces through IRS income records. The mismatch between what your file reflects and what external data shows is what triggers the review. And by the time the review concludes, the overpayment period may already span a year or more. So let's move into what you can actually do, because understanding a problem clearly is only useful if it leads somewhere actionable. Start with the most fundamental step. Confirm which program you're enrolled in, and read the reporting requirements specific to that program, not a general overview. The actual requirements for your enrollment category. The SSAS website provides program-specific guidance, and the difference between what SSI requires and what standard retirement requires is significant enough that treating them as similar will create gaps. If you're not certain which program you're in, and this is more common than it sounds, particularly among people enrolled in multiple programs simultaneously, call the SSA and ask for confirmation in writing. If you're collecting retirement benefits before full retirement age, and you do any kind of work, track your annual earnings against the current threshold before the year ends, not after. December is too late if you've already exceeded the limit in October. The earlier in the year you identify a potential overage, the more options you have. You can adjust your work schedule. You can notify the SSA proactively and arrange for voluntary withholding rather than waiting for an automated overpayment determination to arrive. Proactive contact with the SSA almost always produces better outcomes than reactive responses to notices. If you're receiving SSI, treat the 10-day reporting window as a firm deadline, not a guideline. Build a simple habit. Anytime something changes in your income, your household, or your resources, report it within that window. When you report by phone, write down the date, the time, and the name of the representative. When you report online or in writing, keep a copy. These records are not bureaucratic formalities. They are your primary defense if a discrepancy surfaces later and you need to demonstrate that you fulfilled your obligation. If you're receiving SSDI and you're considering any kind of work, even part-time, even informal, even a small amount, Speak with a Social Security representative or a benefits counselor before you start. The trial work period provisions are specific and easy to misapply. Work incentive planning and assistance programs operate in most states. Federally funded and specifically designed to help SSDI recipients understand how work affects their benefits. These counselors exist precisely for this. Them before you start working costs nothing. Dealing with an overpayment determination after the fact costs considerably more for every beneficiary, regardless of program. Never ignore SSA correspondence. A letter that feels confusing or incorrect still has a response deadline. Missing that deadline can eliminate options that would otherwise have been available to you. If you receive a notice you don't understand, call the agency before the deadline passes. If you receive an overpayment determination and believe you were fully compliant, know that you have two distinct options beyond simply paying. The first is an appeal, a formal process where you present evidence that the SSA's determination is incorrect. This could be because the income wasn't reportable under your program's rules, or the data the agency used was inaccurate. The second is a waiver request, a separate process that doesn't contest the determination itself. Instead, it asks the SSA to forgive repayment because the overpayment was not your fault, and repaying it would create genuine financial hardship. The waiver process is consistently underused because most people don't know it exists. In practice, the SSA approves waivers in a meaningful share of cases where both elements are present, no fault and real hardship. If those conditions apply to your situation, a waiver request is worth pursuing, and worth pursuing within the 60-day window, not at the edge of it. Now let's look at where this is heading, because the pattern over the next 12 to 24 months is fairly readable if you understand what's driving it. The SSA has stated explicitly, in its own strategic planning documents, that reducing improper payments is an operational priority. In plain terms, the agency has every institutional reason to keep tightening compliance detection, and no structural reason to ease off. The automated systems already in place are being refined. The data sharing relationships with other federal agencies are being expanded. The volume of historical discrepancies being surfaced through matching is not expected to decrease. If enforcement continues at its current pace, the number of overpayment notices generated annually will likely be higher in 2025 and 2026. There's a broader fiscal dimension worth understanding clearly. Social Security's trust funds face documented long-term pressure. The program's actuaries have projected for years that without legislative adjustment, the trust funds face depletion within the next decade. That is ultimately a congressional problem requiring a legislative solution. But in the meantime, it creates an administrative environment. This environment has strong institutional incentives to reduce improper payments through every available mechanism. Tightening compliance detection doesn't require a new law. It requires better data systems and better matching protocols. Both are already deployed and being expanded. That's the context behind the enforcement modernization we've been discussing. It's not arbitrary, and it's not temporary. For beneficiaries, the practical implication is straightforward. This environment is not going to become more forgiving in the near term. The window for unreported changes to go undetected is narrowing, and that trend reflects structural decisions about program integrity. It's not a temporary enforcement push that will recede. Adjusting to it now costs very little. Dealing with an overpayment determination after the fact, the letters, the deadlines, the repayment negotiations, costs considerably more. The adjustment most people need to make is not dramatic. It doesn't require an attorney. It doesn't require restructuring your finances. It requires knowing the reporting rules of your specific program, recognizing what events and income changes trigger an obligation, and maintaining a basic habit of staying current and keeping records. That is the entire gap between the people who get caught off guard and the people who don't. The rules didn't change. The enforcement did. And now that you understand that distinction at a level most retirees never reach, how the systems work, who they affect, why delay makes it harder, what the life event traps look like, and exactly what to do when something goes wrong. If this breakdown gave you real clarity on how Social Security's reporting and enforcement environment actually works right now, here's what I'd ask you to do. Subscribe to Macro Signal if you haven't already. hit the button right now before you move on. Share this video with someone you know who's collecting benefits or approaching retirement. The information in this breakdown could save them from an overpayment situation they never saw coming and wouldn't know how to handle. And check out our other coverage on Social Security strategy, benefit timing, and government program changes, because this is one piece of a larger picture that affects every household depending on these benefits. We will keep tracking every development, every administrative shift, and every policy change that matters to real people in real financial situations. Subscribe to Macro Signal. We'll be here when the next one lands.